US economy sees jobs bouncing back, SUVs keep revving up the sales of the Indian automakers, and why one really needs to look at Google parent Alphabet. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Well, time really does fly, isn't it? Time really does fly. I have to say, as I mentioned a couple of weeks back, this is the final episode of 2024. And I really want to start the show by thanking each and every one of you for all the support and love that you've given me this year. The show has scaled new milestones this year, and I also had some amazing opportunities interviewing some of the top fund managers in the world. So, thank you all for your support, and your support is all the motivation I need to keep the show running and also to bring new features into the show to keep improving every single week. Every single week, week in, week out. Right. So, we are about to head to the final episode of 2024. And I really want to say the week gone by was dominated by a lot of economic data in the US. Some Fed speak was also there as we gear up towards the final Fed meeting of 2024 in the coming days. Once the dust settled, the S&P 500 ended the week 1%. Tech-heavy Nasdaq had a stellar run thanks to the likes of Salesforce and other enterprise names that had a good earnings and they really ramped up. The tech-heavy Nasdaq actually jumped 3.3%. The Dow was the only laggard, and I don't know the last time I've said this when one index ended in the red, but that's what happened. The Dow ended the week in the red, down 0.6%. So, ladies and gentlemen, for the last time in 2024, let me welcome you to the first segment of the show, Doctor's Weekly Snapshot, and let me begin with the most important economic data point we received, the all-important US jobs report. So before I go into the actual number of the jobs report, I really want you to keep in mind that the October jobs number was absolutely horrendous. Okay, but you had to factor in the hurricane impact as well as the impact from the strikes. Okay, so that's why the October number was horrendous. It was not really a horrendous number. I mean, if you recall when I discussed the jobs report, I really did tell you that unemployment rates remained steady and it kind of was an external factor that nobody really could control, and it was not an accurate reflection of the US economy at the time. So you got to keep that in mind. So when I tell you guys the November jobs data, you have to factor in the horrendous October jobs report that was very well expected to revise back in November, and that's exactly what happened. Right. With that in mind, the November jobs report was actually a wonderful one, as the US economy added 227,000 jobs, comfortably exceeding the 211,000 jobs that economists were expecting. On top of this, the Labor Department actually revised the horrendous October jobs report upwards to 36,000 from the 12,000 number that was initially reported. But keep in mind, the 12,000, the number 12,000 was a result of the hurricane impact as well as the impact from the strikes. Not everything was rosy, however. I mean, 227,000 jobs, a fantastic number, but it doesn't again tell you the full picture. The unemployment rate actually ticked up 4.2%, and while this was in line with expectations, it's never a good sign. It's never good to read that it actually unemployment rate went up. It was 4.1% report in October. Now it's slight tick, but a tick upwards nonetheless to 4.2%. The labor force participation, however, actually dipped, and this was a surprise. It dipped from 62.6% in October to 62.5%, and the estimate for the labor force participation rate was 62.7%. So it is a negative surprise, and this had nothing to do with the October impact. I mean, people were expecting, the economists were expecting the labor force participation rate to go up. It didn't. In fact, went down, came in worse than expected. So that was a bit of a surprise. Average hourly earnings, however, did rise 0.4% month over month, 4% year over year, topping the consensus estimate on both counts. The jobs data was predominantly driven by healthcare, leisure, and hospitality. And the government, healthcare, leisure, and hospitality, and government. So these were the three sectors. Leisure and hospitality is basically pooled together as one. Which together, so the healthcare, leisure, and hospitality, and government actually accounted for more than half of the job gains. This degree of concentration is not exactly a great thing. So it is something for Fed to consider when they decide in the coming days whether to cut rates or not. Right. The question then remains, where does the latest jobs data leave the Fed? If you look at the overall picture, then the jobs report shows a US economy that is on a very, very strong footing. And that would definitely lead Powell and co to put a pause on the rate cutting cycle. I mean, if the economy is doing really well, what's the point of cutting rates, right? Next week, we will also get the November CPI data, the inflation data. And if that comes in hotter than expected, then one can safely say that there won't be any more rate cuts in 2024. However, I keep coming back. I keep coming back to the previous point of the jobs number being concentrated to few sectors, given, I mean, healthcare, leisure, hospitality, government. So, and it has been a trend going, in recent months that it has been very concentrated, the jobs gain, which suggests that the number we received, the 227,000 number we received, fantastic number, but it doesn't really actually fully reflect the actual picture of the US economy. For instance, the retail trade sector actually lost 28,000 jobs. And also the transportation equipment sector, the transportation equipment manufacturing sector added 32,000 jobs, which simply showed that the workers have returned. So it's not exactly the adding new jobs. It's just the fact that there were strikes happening in October. So these workers were classified as not working, and that resulted in negative impact on the October report. They simply came back. So it's not like you're adding new jobs. It's just that the transportation sector just saw people coming back and taking the jobs that they never really lost because they were striking. So again, it's not a full accurate reflection of the full picture of the U.S. economy. So it's not really hunky dory when you really do a deep dive on the latest economic data, on the jobs data. So 227,000 is a fantastic number, but does it really tell the full picture? In my opinion, guys, no, it doesn't. Now, the more important point is my point doesn't really matter because I'm not the one who will decide on the rate cuts. I just merely tell you guys what I think about it. This is just my opinion. Whether the Fed will see it the same way remains to be seen. Very short, very short segment, but that was the key segment that was the key point that I wanted to discuss with you guys as an investor as we head towards the final weeks of 2024. There was some other developments as well. You had you had Wall Street targets for 2025 coming up as well in the week gone by. And there was a street high target of 7,007. Yeah, there's an analyst who thinks in 2025 S&P 500 will hit 7,007. And when interviewed on CNBC, he basically said he's a fan of James Bond, and that's why it's 7007. Very weird way of putting things right. I mean, he could have said 7,000. He could have said 7,010. Nope, 7,007. Why? Because James Bond number. Things are really going crazy in the market, but on a U.S. economy footing, from the U.S. economy front, things don't seem to be looking too bad, but at the same time, in my opinion, they don't really show the full. They don't really fully reflect the full picture. They don't give you the full picture, and it essentially means that things are not particularly great as the numbers would indicate. That was Doctor's Weekly Snapshot. Now, let me welcome you to the Doctor Goes Home segment, and the Doctor Goes Home segment is going to be a long one because a new month means yet another segment of discussing India's auto sales numbers. Momentum has indeed come back to the auto space as car sales on the back of a very strong October revved up once again in November. All in all, the car sales were about 4% year over year, coming in at about 350,000 units. SUVs were once again the primary driver of this ramp up in sales, which can't be surprising to you guys if you've been listening to me, given that it has been the theme of 2024. I mean, every auto sales number that I keep telling you month after month, SUVs dominate, SUVs dominate, SUVs dominate. So, sound like a broken record, but hey, that is the theme. That is what I got to report. Let's get to the top car makers individually now. India's largest car maker, Maruti Suzuki, had another stellar month, better than October percentage-wise, with sales jumping 10% year over year, coming in at a little over 181,530 units. Exports, while they did not set another record, they set a record in October, they did not set another record, were still really strong, coming in a little over 28,630 units. While the mini segment and the compact segment saw marginal declines, SUVs continued their upward trajectory, with Maruti's utility vehicle segment clocking a year over year growth of 20.4% in terms of sales. The second largest car maker, Hyundai Motor, chose to go public at the wrong time, I guess, because it was yet another muted performance in November from the company. I am invested in Hyundai, and believe me, it's not been a good ride. It's not been a good ride. I did invest. I did get the, I did invest at the time of the IPO. I just feel like the company's timing of IPO has been wrong. It was yet another muted performance in November from the company. Sales declined 7% year over year. Sales were flat in October, so now we've gone into the red now. Exports were the main reason for this decline, as they declined 20% year over year. So that definitely dominated the overall sales dominated the overall sales negativity or the sales decline that you saw for November. Domestic sales also declined, but when you look at compared to exports, it's just a marginal decline. They declined about 2% year over year. Once again, SUVs came to the rescue for the company, helping the company to protect against significant decline in domestic sales, as SUVs contributed to about 69% of the company's total domestic sales. The company is also gearing up for its latest launch, the Hyundai Creta EV, which should help the company, hopefully, as an investor, all I can say is hopefully, to stem the decline in sales. The problem is that the launch is coming at a time when competitors are also launching multiple EV models. So, how it navigates this increasingly competitive environment remains to be seen. I continue to remain invested in the company, but I haven't bought more shares since the IPO. Whatever declines have been happening, I simply haven't bought more. I just feel like there would be a further pullback in the name, given the fact that the sales have now gone from flat to red. Yeah, they're launching a new EV model, but now they're going to compete with several others, so that's going to be an issue. So I've not bought more shares in the name since the IPO. Should there be a meaningful pullback, which I kind of predict, maybe I'll dip my toes in it again. So I do believe in the long term prospects of the company, but for now I think it looks like a pretty rough ride awaits in the coming weeks and months. Moving on to Tata Motors now. November was better than October. However, for a player that has been dominating the passenger vehicle space via the EVs, still not a great month. Sales were up 2% year over year. Its EV sales actually registered a 13% year over year decline. I mean, although the company continues to be the king of the EV space, there are serious questions as to how long it can keep the crown. Competition, like I said when I was describing Hyundai sales, is seriously heating up, and the company also has to ensure that its latest launches keep the competition at bay. My entire bull case on Tamo relies on that. I am an investor. I continue to remain an investor in Tata Motors. I've been there for a long time now. But my entire bull case is the fact that it dominates the EV space. So while I continue to hold shares for now, I haven't sold any. I would be carefully watching the reaction to its new EV models relative to the competition. Any significant weakness, and there is a very high chance that I exit my position in the name. I might even start off 2025's show by saying, guys, I'm out of Tata Motors. I don't know. It has been a company that, while it has delivered stellar returns, its competitiveness, its moat is definitely coming under threat now. So once the moat is gone, then there's no point in, the story has changed, structurally and fundamentally the story has changed, and then I will have no choice but to exit. But for now, I'm holding on to the shares. Will be very interested to see how its latest launches competes with the other competitors, how its existing EV sales. I mean, 13% year over decline is, this doesn't give me much positivity there for sure. But I'll be monitoring it, and probably the next sales report in January. So December sales report will probably give us more picture on how Tamo is doing. And it's not looking particularly great. I'm looking a little bit unconvinced, with the name, and it's definitely a show me story. And the main reason should I exit Tamo would be Mahindra and Mahindra, my other investment in the auto space. Yet another incredible month for this automaker, as it registered a 16% year-over-year growth in domestic sales of UVs. The company's tractor segment also had a good month, although not as close to as to the UV division. I'm extremely excited for the company's BG6E and the XEV9E EV models set to launch in the coming months. The design looks absolutely brilliant. Models boast an incredible range, So it would really be important to see how it fares against competition. Truth be told, my money is literally and figuratively is on Mahindra and Mahindra to eventually unseat Tamo from the EV throne. The question is, it's a matter of how fast it can do it. So as where I look at it, how I look at it, where I stand, it's a matter of when and not if, and that would probably dictate how the company's future growth trajectory would go. How whether it can, how fast can it dethrone Tamo from the EV crown would of course determine the future growth trajectory of the company. Okay, we're now moving to the two wheelers. Hero MotoCorp had a bad month, with sales actually declining 6.5% year over year, primarily driven by a decline in the scooter sales. The decline could have been far worse had it not been for exports, which actually saw a stellar growth of 36% year over year. The good news is that the company has a line of scooter launches coming up, so in all likelihood, November could end up being an outlier. TVS Motor continued its growth trajectory with sales jumping 12% year over year. EVs dominated the month with sales surging 57% year over year. This is on the back of a solid 45% year over year growth that it registered in October. Exports had a really positive month as well. Sales jumped 25% year over year. So TVS Motor had definitely a very, very strong November, and this is on the back of a very strong October. I am an investor in TVS Motor, have kept my shares very much intact, and have no plans to sell anytime soon. Royal Enfield had a mixed month with bike sales up 2.5% year over year, primarily driven by exports, which actually surged 95% year over year, more than offsetting the 3.9% year over year sales decline seen in the domestic sales. Finally, my latest two-wheeler investment, Bajaj Auto, had a good month. Sales jumped 5% year over year, again, primarily driven by exports, which surged 26% year over year. For Bajaj, however, domestically, it has not been a good story, and it has not been a good story for quite a while now. In November was no different. Sales declined by 7% year over year. So clearly not a good November for the automaker in terms of domestic sales. Bottom line, what do I make of all these numbers? Simply reading out the numbers is not what we do on the show. What do we make of it? The market momentum seems to have been back for passenger vehicles, as evidenced by a very strong November on the back of a strong October. SUVs have been the major driver throughout this year, so there is no surprise that we close out the show in 2024 by reiterating the same. As we look forward to 2025, the real deal would be the EV space. We have a series of launches geared up from the top car makers, including India's top car maker, Maruti. It pains me to say this, given that I'm an investor in the name, but it really does look like Tamo's days as the king of EVs appear to be numbered. The landscape for EVs in India, unlike in the US, is becoming increasingly competitive, and as such, I'm not sure how long Tamo can hold on to the lead. M&M's much awaited launches excite me the most, and like I said before, my money is on the company eventually dethroning Tamo from the king of EV space. Maruti also has a very strong chance simply because of the strong positive sentiment in the name. Whatever happens, ladies and gentlemen, if SUVs were the theme for 2024, then the theme of 2025 looks set to be electric SUVs. Exciting times lie ahead for India's auto space, as well as for India's auto investors. For sure, that's absolutely a certainty. On that note, we're going to head to the final segment. One last time in 2024, we're going to head to Dr. Dissects, and we're going to wrap up 2024 by dissecting Google parent Alphabet. Ticker symbol is GOOGL, Google, without the E. It was yet another impressive quarter from Alphabet, in my opinion. Q3 revenues of $88.3 billion were up 15.1% year over year, and they comfortably beat analyst estimates by $2.05 billion. Diluted EPS of $2.12 was up 36.8% year over year and comfortably beat analyst estimates by 27 cents. Despite another round of significant capex spending, the company's operating margin came in at about 32%, which translates to a year-over-year expansion of 450 basis points or 4.5%. Free cash flows for the quarter came in at $17.6 billion, which took the trailing 12-month free cash flows to $55.8 billion. The company ended the quarter with, get this, $93 billion in cash and marketable securities, a decline Definitely a decline from $101 billion it had in the second quarter, but 93 is still strong enough. The company maintained its quarterly dividend payment of 20 cents, which it had announced in Q2. New CFO Anat Ashkenazi, who replaced long-standing CFO Ruth Porat, offered some commentary as to what to expect from the company in the fourth quarter. She reiterated the company's stance from Q2 that to capitalize on the AI revolution, it would require continued meaningful investment. Moreover, the company would continue to face headwinds from increases in depreciation as well as from higher expenses linked with the higher level of investment in technical infrastructure. That's fancy jargon for saying we're just going to keep spending on AI infrastructure. At the same time, the new CFO also stressed upon the company's continued attempts to drive efficiencies of its technical infrastructure as well as leveraging AI to streamline operations across the company. There was also mention of optimizing headcount growth, whatever that means. I'm assuming that they're probably going to make the overall setup more efficient. Maybe some job losses might be happening. I don't know. They just said optimizing headcount growth, whatever that means. Finally, the company also mentioned that advertising revenue will face twin headwinds, double, from the base effect resulting from the strong advertising revenue in the second half of 2023, as well as from the pull forward of the Made by Google launches into Q3 from Q4 this year. So a little bit of accounting, changes, nothing dramatic, but the CFO did mention that. Now, on to the main takeaways from Alphabet's third quarter. The last time I talked about Alphabet, I mentioned how the second quarter belonged to Google Cloud as a result of the progress made by the segment. Google Cloud's Q3 performance, in my opinion, blew even the Q2 performance out of the water and firmly placed Google's cloud business as a serious potential challenger to Amazon Web Services and Microsoft Azure. While the second quarter marked the first time that the Google Cloud segment crossed the 10 billion mark, for the Q3 cemented the cloud business as a $10 billion plus business as the segment brought in $11.4 billion in revenues. The year-over-year revenue growth was also on the up as it went from 28% in the second quarter to 35% year-over-year in the third quarter. The segment's operating margin also significantly expanded from 11% in the second quarter to 17% in Q3. While this is still far, far behind from both AWS and Azure, it is definitely heading in the right direction. And given the leeway that's available for the company to scale up the business, as well as the pace at which it is spending to grow the segment, I do expect the company's cloud segment to catch up with the top two sooner than later. The performance of the cloud segment also vindicated the company's decision to keep spending on AI infrastructure to gain a stronghold in the AI arms race. The AI investments in the cloud business is enabling the company to win larger deals, and during the third quarter, it led to a 30% deeper product adoption with existing customers. Not my words, management's words. The company is also seeing very strong demand for its AI-powered cybersecurity solutions, with customer adoption of the company's Mandiant power threat detection increasing 4x during the last 6 quarters. There is still a long way to go before GCP can Google Cloud Platform can start to put pressure on both AWS and Azure, but Q3 showed how the cloud segment is heading in the right direction. It also showed that with the help of the AI-related investments made by the company, Google Cloud has not only evolved to a significant challenger to the top two from being an also-ran, but it has also helped the company offset to an extent the slowdown seen in the bread and butter search business as well as in YouTube. The timing of this growth of Google Cloud could not have been more perfect, in my opinion. Next takeaway number 2. The company's search business and YouTube are witnessing a growth slowdown, which is a concern as the likes of OpenAI and Perplexity AI grow deeper pockets to challenge Google. In Q3, while both Google Search and YouTube ads each registered impressive year-over-year revenue growth of 12.2%, the growth compared to the second quarter definitely slowed down. For instance, in the second quarter, Google search revenues grew at 13.8% year over year, whereas revenue from YouTube ads grew at 13% year over year. This was the second straight quarter that both these segments were registering slowing revenue growth, and the slowing growth of both these segments also led the company's overall revenue growth to slow down from 11.1% in Q2 to 10.4% in Q3. While the growth slowdown is not a worrying concern yet, it is not an area that should be ignored by investors, in my opinion. According to eMarketer, Google's search ads business is expected to fall below 50% market share next year as a result of increasing competition from Amazon. And when one factors in Microsoft Bing as well as the likes of Perplexity AI, then the threat becomes even more significant. The company also faced a slowdown in spending in the US from two of its largest advertisers, e-commerce giants Temu and Shein, which also affected its growth. All of this lends further support to the company's decision to spend heavily on AI. During the quarter, the company rolled out AI overviews. I'm a fan of this to over 1 billion users. The company is witnessing strong consumer engagement with ads that the company has placed above and below overviews, which is promising. Management during the earnings call did announce that they have plans to monetize AI overviews in the long run. Thank God. But the long run may have to come sooner than management's own calculations based on the current competitive landscape. Finally, I cannot wrap up Alphabet's deep dive analysis if without mentioning its autonomous vehicle division Waymo, which is part of its other bet segment. The division has made tremendous progress, and I don't know whether you guys have read it. On Thursday, I believe, Waymo did announce that it's moving into Miami, which actually led Uber and Lyft to fall down. I mean, that's a different story. That's a whole another episode that I need to do. But Waymo's done a tremendous progress. It during Q3, management reported that it drives more than 1 million fully autonomous vehicles today and undertakes over 150,000 paid rides every week. Now, in addition to the Miami expansion, remember the division has also partnered with Uber in Austin and Atlanta, which should offer it a significant tailwind in the long run. During the earnings call, management also mentioned that the company was planning to expand in new market, albeit without a fixed timeline. And now we already know that one such expansion happened last week, and that was Miami. About a few weeks back, Waymo closed a $5.6 billion funding round with the intention of expanding its coverage across the US, led by Alphabet, along with external investors such as Fidelity and Tiger Global. As the autonomous ride hailing race heats up, with Tesla also announcing its Cybercab, robotaxi, whatever you want to call it, first mover advantage is very, very crucial. And based on the commentary that we received in the Q3, along with the additional funding, in my opinion, Waymo is well positioned to capitalize on the AV race. The segment's revenue might be a drop in the bucket to Alphabet today, but in the long term, based on current evidence, it most certainly has the potential to be one of the growth catalysts of the company for the future. I'm taking my pen, I'm taking my book. That can only mean one thing. We're going to talk about valuations. Right. The company, according to LSEG data, currently trades at 19.7 times, which continues to make it the cheapest among the sensational six, which are Alphabet, Meta, Amazon, Microsoft, Apple, and Nvidia. It continues to trade cheaply relative to its own historical multiples of 22.1, which is the 5-year historical median, and 22.4, which is the 10-year historical median. The median PE multiple of the sensational six stands at 31.1, slightly higher than my previous estimate of 31. Like I did the last time I talked to you guys about Alphabet, I'm dropping Nvidia from the peer list given that it belongs to a different category, which takes the median PE multiple to 31, much higher than my previous estimate of 30.2. Now, the last time I wrote about Alphabet, I made a case about Alphabet deserving to trade at the median PE multiple 31 times in this case. However, the dynamics has completely shifted in the last 3 months. Despite making significant headway into the AI race, Google's search business is under considerable threat for the first time in years due to twin shocks of regulatory challenges, as well as an increasing competitive landscape thanks to the emergence of the likes of OpenAI and Perplexity AI. As such, I don't believe that it would trade at multiples of 30 times and above anytime soon. However, it certainly deserves a higher multiple than what it is currently trading today. Taken things together, I am assuming a forward PE for my calculations of 22.4x, slightly lower than my previous estimate of 22.5x. So you have the forward PE estimate 22.4. It's simply the landmark has dramatically shifted. The consensus estimate for FY24, according to LSEG data, stands at 7.92, higher than my previous consensus of 7.65. Last time I talked to you guys about Alphabet, I mentioned how, on average, the company has beaten its full year EPS consensus estimate by 4.05%, with FY22 being the only outlier. I have maintained my assumption that the company would beat analyst estimates by the same figure, 4.05%, which brings my FY24 EPS estimate to 8.24. Okay, 8.24. This would require Q4 EPS to come in at 2.3, not an unreasonable estimate, given that Q4 has traditionally been its strongest quarter in the last 5 years. Again, FY22 was the only outlier. An FY24 EPS estimate of 8.24 would imply a year over year growth of 42.1%, much higher than my previous growth estimate of 38%. Given that both the competitive landscape and the regulatory challenges would be more intense in the coming years, I simply don't expect the company to maintain the same growth in FY25. As a conservative measure, I've assumed a year over year EPS growth in FY25. So, EPS growth in FY25 to be 34.8%. This is basically the average of the FY23 EPS growth and my projected EPS growth in FY24. So 34.8 is clearly lower than my previous estimate of 38. At this growth rate, FY EPS for FY25 EPS is projected to come in at 11.11. I didn't design this, it just so happens. So FY25 EPS estimate is 11.11. All right, so 11.11, marginal increase from my previous estimate of 11.02. So you have 22.4. Multiply that with 11.11. You get a price target of $248. Okay, $248, which is basically the same as my previous price target, but which does suggest an upside of about 40% from current levels. Given the significant upside from current levels, and given that the company has so far navigated the major headwinds it has faced, I am maintaining my rating on the stock as a strong buy. So there you have it, folks. We're wrapping 2024 up on a very positive, upbeat outlook. Strong buy on Google, price target unchanged at 248. Considerable upside from current levels. Now, every time I make a strong buy case, I do have to talk to you guys about risk factors. There have been major developments with respect to the company's regulatory issues since the last time I talked to you guys about Alphabet. Most specifically, a US federal judge in August ruled that the company maintained an illegal monopoly on search. Separately, the company is also facing a landmark case against its ad tech business, which goes into the closing arguments phase in November. A defeat there could create a significant dent to the company's future profitability, and as such, it is a major risk factor to my bull case. The other risk factor remains the competitive landscape, which has taken a turn for the worse from Alphabet's perspective. Companies like OpenAI and Perplexity AI are fiercely competing with Google and are also moving into the ads business through features such as sponsored question system, which, if successful, could really shake up the $300 billion digital ads industry and threaten Google's ads business. This is once again yet another significant risk factor to my bull case, one that investors, prospective investors and current investors need to seriously factor in. Bottom line, Alphabet had a seriously impressive quarter, with the company beating on both the top and bottom lines. Google Cloud took a significant step forward in being a formidable challenger to both AWS and Azure, delivering strong revenues and even stronger margins. The timing of growth of the Google Cloud segment comes at the right time, given that the company's search business and YouTube show signs of slowing growth. Both segments saw revenue growth decline for the second straight quarter, and while for now the situation is not worrying, given the increasingly competitive landscape, the future does look less rosy. About to finish and the light goes off. Finally, the company's autonomous division, Waymo, continued to show tremendous progress and is well positioned to be a seriously strong growth driver for the company, even as the AV race heats up. From a valuation standpoint, there is a significant upside from current levels, as seen here. And with the company's AI investments starting to pay off steadily, as evidenced by the growth seen in Google Cloud, investors, in my opinion, ought to use this opportunity, or ought to use any pullback, and ought to use any meaningful pullback to get in the name. Based on the company's Q3 report, just don't write off the search giant yet. Well, that's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. Thank you for all the support you've given me in 2024. I wish all of you and your families a Merry Christmas and a very, very Happy New Year in advance. I will see you all once again in January 2025. Not sure about the exact date, probably mid January, but I will see you in Jan 2025. That's a promise. Until then, ladies and gentlemen, stay safe and make some money.